Welcome. Thank you for joining us tonight. It is a real estate accredited or multifamily real estate virtual meetup focused on educational topics, and we try to make it interactive. So do not hesitate if you have a comment or question. Let's go ahead. Today, our topic is the 2024 Multifamily Outlook. As usual, we do focus on in-place commercial multifamily value add. This is our niche. This is what we know, our bread and butter. We've been doing that for many years and try to stay focused on that. There are a lot of other asset classes out there, and it's hard. It takes time to be proficient at one. So that's why we just focus on in-place commercial multifamily value add. So the outlook, and I will give you my sources later on at the end of the call here regarding this 2024 multifamily outlook. First, I want to talk about a number of economic indicators that favor a soft landing. That's something that has been discussed a lot, and the Fed is trying to avoid a recession, obviously. While there are indicators favoring the soft landing, there are also a lot of headwinds. And we'll start with those on the left here. Headwind number one is the core PC inflation, or inflation in short, that is still relatively high, higher than what the Fed would like to have at 2%. There is also an inverted yield curve, which means that short-term treasuries, they produce higher returns than long-term treasuries, which usually is an indication of an upcoming recession. So that's certainly an indicator that a lot of economists are looking at. Also, the Fed is doing quantitative tightening, and that's on top of the Fed interest rates being high. Basically, the quantitative tightening is like they shrink the supply of money, so which drives also the economy a little bit hotter and the inflation a little bit higher. Then there are the banking sector that has some risks. We've seen some banks that have failed early 2022. I think we're not out of the woods, because basically the number one problem in that area is that the banks have placed the money that they hold for their investors into instruments that have their rates that have changed, and now technically they may have some losses. And that's what happened when investors realized that they wanted their money back, and that's how some of these banks failed. Now, I think, again, the government is working hard to avoid a bank run, obviously. It's probably not a huge risk, but it's still something that is out there. Then there is the business and personal debt risk, also in the news a lot. There's a lot of debt, credit cards, revolving credit lines, people buying a lot at credit, and it's putting a lot of pressure on these families. And here, obviously, the risk is, can you still pay your rent? So that's a little bit of pressure on multifamily. Otherwise, geopolitical risks, the Middle East and Ukraine still have wars going on, and that's like the whole world is a little bit looking at what will be the outcome. Hopefully, it will get resolved ultimately peacefully, but we are not, as far as I know, there's nothing clear on any of those two fronts. A little bit of pressure on the economy and mostly the energy sector. Finally, government shutdown and funding risk. That's a recurring theme over the years. I'm not sure it's like a real thing to be worried about, but who knows? For political gains, they might decide to shut down the government, which will create trouble. From a tailwind standpoint, still a strong job creation, about 200,000 jobs per month. Unemployment rate is low, under 4%. Some particular numbers on inflation adjusted retail sales growth is at 0.2% year over year, meaning that basically like the goods pertaining to goods, the inflation is really low. So hopefully we'll go back to basically normal situation. Corporate profits are stable, which is also good news. So the companies can continue to invest in the economy and therefore creating jobs, etc., etc. The wage growth year over year is pretty strong. Employees can basically they've been in general, I would say, paid to be able to sustain the inflation overall. And interesting indicator as well, the labor participation is at 62.7%, which is close to a pre-pandemic number, meaning that, in other words, people went back to work and we're back to pre-pandemic situation of participation of labor from the population. So those are the two, headwinds and tailwinds. Now, my next slide is more focused. Again, we're talking about multifamily, so demographics and affordability are key things. And so if you look at the largest pool of renters, which are millennials, so between 27 and 42 years old, and actually, yeah, here the statistics just showing 20 to 34, but we have more than half of them are renting, right?
Yeah.
So that's very interesting point there. A lot of people are renting these days, and I think the explanation is right below that, because historically, for the past 12 years, there's been a gap between how much it costs to own a home compared to renting an apartment, right? And this gap actually went higher over the years. And you can see right now it's at all-time high of average, national average at $1,300 between average rent and the cost of owning a house or homes. And now you can see that, again, over the past 20 years, the numbers were, I would say, probably in the average, like between 40-50%, quite a bit, like especially the 2007 to 2021. But right now, at 25% of households who can afford buying a house. I think this is very interesting fact. Very strong market in number of renters, and that's going to stay there for a while. Also, another point, and I'm sorry, it's a little bit blurry. I just added this chart before we started the call here, and I found it interesting for two reasons. Because number one, the consumer sentiment here, it actually bottomed sometime between mid 2022, and it got lower than the 2008 timeframe with the Great Recession, right? So that's remarkable that it touched a point that was below that, and there was so many bad news and inflation and so on. But my point here is to say, particularly, that it's trending up again, and it's expected for 2024 to continue in that direction, especially as we anticipate a soft landing overall in the economy. And what's that's going to do on the creation of households, people will be more relaxed and say, okay, I'm going to, stop living with my relatives and start my own household. And usually, like, this very first way to start a household is going to be to rent an apartment. So we can expect number of households to increase, which you listen to what we said in the past calls or during our webinars. Historically, the number of households creation has been low, behind averages for the past several decades. And it goes back to an affordability problem. And just if the overall sentiment is negative, people are not going to start a new household. So that brings us to the next topic, which is construction. And actually, let me remove that. I meant to remove that. There you go. So constructions, it's not only, I think a lot of people in the industry, in multifamily industry, they saw these indicators some time ago. And you can see that the absolute constructions numbers between 2023, 2024, those numbers are at all-time high. 480,000 units, new construction in 2024 expected, which is, again, there's a trend, lack of housing and households that were not being formed as expected. And now there's all like this demand, there's this pressure on the market, and which led to very low vacancy rates and overall very high rents as well. But so developers, they saw that and they said, okay, we're just going to build new units. And if you can see, if you have these 480,000 deliveries in 2024, those are projects that are certainly have been started either in 2022 or 2023. We're talking about deliveries. And so the economy was turning around. There's demand on building new units. And you can see overall in the country, there are a lot of markets where there's more than between 3% or even more than 5. So that would be the orange discs as well as the red discs. More than 3% or 5% of the whole inventory is expected to be available as so additional inventory in those markets. If we take, I'm here located in Atlanta, between 3 and 5% of all the units of Atlanta, there will be new construction there. So now, obviously, new construction is going to be Class A apartments, very high rents for very wealthy, I would say, probably white collar type of tenants. So we're not necessarily, when we do value add, we're not necessarily looking at Class A apartments. It depends case by case. In a lot of these markets, you can see Salt Lake City, Denver, Phoenix. I'm just going over the red. Austin, Nashville, Charlotte, and Jacksonville. There's going to be a lot of supply in those markets. And as a result, as I mentioned, number one, higher vacancy. Number two, there will be probably a little bit lower rents. So talking about rents, and I'm going to make a little room. Sorry about that. So I can paste this other chart that was misplaced. I'm trying to, yeah. There you go. The rank is the same. On the top, it's the forecast made by Marcus and Millichap which is a very large broker in commercial real estate. And the expectation that on a national level, we're looking at 1.5% year-over-year change in rents, which is still pretty positive. It is positive, obviously. But my point is, at the same time, in all these markets that I've shown on the prior chart, there is, so for instance, I mentioned Atlanta. Overall, Atlanta, as of September 2023, there was pressure on the rents, -4% in the market. Austin was in red as well. Phoenix was in red. Like all these cities where there's a huge expected number of units that are going to be delivered, which is pretty much in line with the 2023 deliveries, is going to be, there's been pressure on these rents. But San Antonio is in negative, about Texas. And what else? Nashville was also one of those markets on the prior chart. So it's interesting. You can see the correlation here and the pressure on the rents. At the same time, there are some markets where there's still a lot of demand. Interestingly enough, Midland, Odessa is very volatile market. It's an oil, I believe, market, oil driven. So when oil is expensive, there are a lot of population growth there. And then when oil is cheap, you have negative 15% rents. So tough market to invest in my opinion. I'm not, let's see if I see anything interesting. College Station. Yeah, I know a lot of people who are looking at deals there. Some of my students, 6%.
Hard workers, college town,
Yeah. Trenton,
earnest
New
people,
Jersey,
very hard workers.
Rhode Island, Columbus, Georgia. Interesting. Newark. The kind of smaller markets overall, not necessarily think markets that I would look at personally, but it's just to show there's going to be always highers and lowers. But my point was mostly on the negative numbers and the relationship with deliveries of new units. And again, that's something we've discussed quite a bit. There's been a lot of pressure on the cap rates, or in other words, on the prices because of the interest rates being high. And as a result, anybody wanted to sell something over the past year, they were expecting higher prices. But at the end of the day, the buyers, they couldn't afford it because of the interest rates being high. So as a result, there were a record number of transactions between 2021, 2022. We are 21% below average in the 14 to 19 average. But really, if you compare to 2021, 2022, we're like 40% below those number of transactions. So a lot of the larger markets have been very impacted, minus 44% in Atlanta, for instance, 44% in Dallas Fort Worth. But interestingly enough, and that's something also I've heard several times, there's been a little bit of shift of investments to the Midwest. And you can see the number of transactions in mostly Midwest markets, except Fort Lauderdale, Boston, Miami there. But interesting to note, I think it's not so necessarily something to pursue right now if you're not in those markets. I always recommend to active investors to stay like closer to where they live. And but I wouldn't say if you're in Texas necessarily start to look for deals in Milwaukee and Cleveland. All right. And also interesting, I know there's a lot of articles out there on loans not being paid on commercial real estate in general. And obviously, like the headlines and other, the more the ugly, sensational type of news, the more interest it will gather and clicks, etc. So it will. There are a lot of stories out there. If you look, compare the delinquency rate on loans, overall, it's not terrible. You have 3% on credit cards and auto loans,
If you're
but the multifamily compared to everything else is in the bottom of all the loans. So below 0.5% right now, probably 0.4%. So it's still in a good place. Not a lot of loans that are not being paid and properties that are being foreclosed on. And that's also something that we discussed in another call, because there are many ways to work on avoiding this type of situation. Before you get there are many steps you can take. We're getting close to the end here. I just wanted to talk a little bit about the interest rates. Over the past year, there were several increase in the interest rates. The expectation as of December, it was that the rates remain flat. Actually, they are still flat for now. There's an expectation around mid-year. Half of the predictions are saying it will remain flat. Another half is going to go down, and by the end of the year, everyone is thinking it will go down. So,
Come on.
I think that's the expectation. In my
100%.
opinion, since the last Fed meeting, they didn't raise again. Maybe the next meeting they are going to keep it flat, but I think we turned the corner personally, especially now that the inflation is getting better.
2%.
There's no reason to keep interest rates that high. In short, things are going to be, I think, a little bit, our life will be easier with the interest rates going lower. There's a lot of demand. There will be more demand, a lot of people renting apartments. And I still strongly believe that this asset class, the commercial real estate asset class, has good days in front of us. And yes, there will be opportunities. There will be good opportunities maybe to buy from distressed sellers. But otherwise, as long as you do your underwriting properly, you look at your numbers properly, or you look at you stress test as usual the outcomes and run some what ifs scenarios, I think it's going to be bright. It's going to be a good year, 2024.
Yes.
So I just wanted to finish with my recommended resources. Two people I follow particularly. The first one is Jay Parson, who is a rental housing economist. I took in both cases, their title on their LinkedIn page. But Jay is an economist with RealPage and focused on very specific. He's doing an article like once a week or so. Very interesting trends, etc. My favorite is John Chang, who is senior vice president and national director at Marcus and Millichap Research and Advisory Services. So again, Marcus and Millichap is a large national commercial real estate broker. RealPage is actually a data aggregation company that's selling services if you want to get statistics and so on. But those are two, Jay Parson and John Chang. Actually, it's Jay Parson. Sorry about that. The two people you can follow if you're interested.
Yes, thank you. Whew.
Thank you everybody for joining. We had a good discussion here with Carl and Paula. And if you have any questions, as usual, you can email me at philippe@boostmycapital.com or take a picture of the QR code there to
Careful
reach
what you ask
my
for,
bio page. So
your
have a
brain is
good
so
evening and Happy New Year to everyone. And we'll see you next time.
All right, thanks,
All
Philly.
right.
Thanks. See you later,
Thank
Carl.
you.
Thanks. Bye,
Bye,
Paula.
y'all.
Bye-bye. Bye-bye.
All right.